It's time for the Trading Stocks Made Easy podcast. Each week, Trading Stocks Made Easy demystifies stock trading and investing so you can profit big. And now, here's the host of Trading Stocks Made Easy, the wealthy investor, Tyrone Jackson.
Hey everybody, it's Tyrone Jackson, the wealthy investor, and welcome back to another episode of Trading Stocks Made Easy. Today, we're talking about trading and investing with a goal in mind. And even if you think, well, not so much me, Tyrone. I want to make as much money as possible, and I want to be able to take that money out of my account and spend it and make my living as a trader. That is great. There's nothing wrong with that. But sometimes you will do better if you trade with one single goal in mind. So let me give you a scenario, and you think about how well it's applicable to your life. I have found that my students make more money when they have a single goal in mind. Hey, I want to double the size of my portfolio, and then I'm going to take profits and pay off my house and get rid of my mortgage payment. For others, it's I'm saving up for the down payment of a house. I want to double the size of my account so that I have the down payment for my new house, and I'm willing to wait 2 to 5 years to do that. For others, hey, I need to pay for college for 3 kids, so how am I going to use the stock market to supply the money to pay for some or all of the tuition? So what am I saying to you right now? If you have a goal in mind, you are more likely to achieve it because you'd be using dividends, covered call income, cap gains for the sale of the stock, and the stock that you are holding to help you reach your goal to do whatever it is you want to do in a 2 to 5 year period. Now, why that number 2 to 5 years? Well, in the Wealthy Investor Program, if we're trading a stock or investing in a company, one of our little secrets is that stock has to have gone up 5 years before we even purchased our first share. Now, past performance is no guarantee of future success, but we can hang our hat on some patterns that have worked. So, when a company goes public, I know the earliest that I would own that stock is 5 years from now, because I want to be able to rest to some extent on its past performance. Now, if a stock has gone up 100%, doesn't mean it's going to go up another 100%. But in my research, the stocks that I choose tend to go up 100% every 5 years. Now, you have to be a little bit of an experienced trader and investor to understand this next idea. On Wall Street, there's a saying, a trend in motion tends to stay in motion. A trend in motion tends to stay in motion. In other words, if long as a company is experiencing top-line revenue growth, great growth on the bottom line, and paying a dividend, that is a trend that tends to repeat itself over and over and over again. Now, another reason why shares tend to go up are something called share buybacks, which I've talked about on the show before. If the board of directors are constantly buying back shares from the public market, you are shrinking the amount of shares available for the public to trade, and those shares available is known as the float. So if I keep drawing in more money in the prior quarter and I'm buying back shares, what's happening to the float? It's getting smaller, dividends are going higher, and that feeds this notion that a trend in motion stays in motion. So I want to stop here for one thing. This is not a game of luck. It is a game of skill. When you're trading and investing in the stock market, those who do extremely well are employing the same skill set over and over and over. This is why if you're one of those people trying to get rich buying $7, $8, $9 stocks, or in this market, stocks under $50, good luck. You'll make a little money here and there for sure, but your portfolio won't accelerate or rise 50 to 100% within a 5-year period. Why? You are not where the institutional investors are. In order for you and I to be successful in the stock market, we need to be trading the shares that the market likes, not the ones that our brilliant mind, our small brain tells us is going to take off. that rarely happens. So the stock market is a series of patterns that repeat themselves over and over and over again. So as I've shared with you before, I've put 2 daughters through college largely using the money from the stock market. Why? Because the cost of going to college at a really good school these days is somewhere between $80,000 and $150,000 a year. Now, what is it going to take for you at your job to earn an additional $80,000 to $150,000 a year? Most people can't do that, right? You can't up your salary $80,000 to $100,000 a year simply because you have a college tuition payment. So what do? They take out loans. Well, if you take out student loans, you are borrowing $80,000 to $150,000 a year. And when your kid graduates college, if they have $300,000 to $400,000 in debt, are they going to be earning $100,000 to $300,000 to pay for that debt? Probably not. Okay? So therefore, we can lean on something like the stock market because we won't be trading time for dollars when we put that money to work. So if I were you and you were planning for college tuition, you could start an account that has that goal in mind. In other words, you would have your trading account and a separate account for your kids or your grandkids' college. You'll be using call option premium to grow the value of that account. The more dividend-paying shares you have, the larger your dividend checks. And if the market likes the stock because it's in line with the 5-year pattern, you are off to a good start. Remember, this is about having a financial education. And the people who do best in this country are the ones who invest their time and energy and effort in learning how the stock market functions so they can profit from it. If you're new to the stock market, how else are you going to pay for college? For your kids, your grandkids, do you have a plan? Well, maybe somebody left you some money, or you're going to use a home equity line of credit or part of your retirement if you're retired, and hope that things work out. What I'm teaching you here today is no longer about hope. It's a plan that actually works. So with that said, don't be negative. Don't poo-poo the plan. Just be open to it. You may learn something about yourself, about how money works, how to choose stocks better in this account where we have a goal, which is to raise money for future college tuition. All right, let me give you a couple of guidelines to go off of, and then you can learn the system and make it your own. That's what's exciting. You see, in the stock market, there's no limit to the amount of money that you can earn, and you get good at reaching every single goal. So I'm happy for those of you who've paid off your house because you've adopted the wealthy investor method. Now let's pay for college. This also works if you want to give money to charity, but today we're really going to just talk about how to build an account that allows you to pay $80,000 to $150,000 in college tuition. And just before we get going, that $80,000 to $150,000 in college tuition, that's today. So if your child is going to college 4 years from now, their college tuition is going to be over $100,000. That's why you want to use assets like the stock market, because as they go up in value, they kind of keep up with the price of college tuition. Now, let me share with you my experience really quickly. So I wasn't worried about college tuition because I have covered calls, which means I have guaranteed income. What I didn't know as an educated parent was the price of college today is different a year from now. Here's how it actually works. The school gives you the price for tuition, but they don't give you the price for room and board and the meal plan. Remember, I said the meal plan, right? We'll get back to that. Okay, so the price that they quote you, let's say a college says, hey, it's $50,000 a year, right? What they don't tell you is the cost of college goes up on average about 3%. We're going to add 10% for the tuition because it makes the math easier. So when my kids get into a school where tuition is $50,000, next year it's going to be $55,000. The year after that, it's going to be closer to $61,000 because the cost of providing the education generally rises 3%. I'm using 10%. So wherever you start when it comes to investing for college, that is not where you're going to end up. I can tell you that for sure. Also, the cost of room and board also rises. This is why many parents, after the first 1 or 2 years, pull their kids out of the college dorm because those dorm fees are going higher, whereas if you pay for a house and you rent the house that has 3 bedrooms that cost $3,000 a month, your cost as a parent goes down because you're able to split the house payment by 3. Now, if you're upper middle class, I've seen this one work. A lot of parents actually go out and buy an investment property, right? So they're splitting their mortgage payment 3 ways, or I've even seen it where they charge rent for the 2 subsequent bedrooms and their kids' rent is actually free. At the end of the 4 years, if the house has gone up in value, they simply sell it for a profit. What I like about this strategy is it's well thought out. It's an educated mind. Why not get the mortgage paid for free for 4 years? Your kid graduates, you sell the house for a profit, 10, 20%, and you cut your dormitory expenses down. Now, here's the other thing they don't tell you about college is the cost of the meal plan. Now, for some strange reason, which I have yet to identify, college kids get hungry. Isn't that weird? Like every day they want to eat and drink something. The cost of meals on the meal plan also rises. So parents are initially enthusiastic about their kid getting into college, and a lot of these colleges these days will also say, no, we'll give you a $5,300 scholarship annually, which basically means you're only getting $2,500 off the tuition, but they raise everything else. Why? They want you to be able to say that your kid got a scholarship to go to college, but then they raise the meal plan and the dorm, and you're right back where they want you. Okay? I'm only telling you this from personal experience because both my daughters got scholarship money to go to school. So I was the proud dad who was like, well, this school gave my daughter a scholarship. But when we added in the increase in price in the meal plan and then the dorm fees, guess where I was? Right back where I was before the scholarship was actually extended. So I had the bragging rights as a parent, but mathematically, I was right where they wanted me to be, right in the pocket. So how do you pay for this? Okay, this is how you pay for it using the stock market. You want to start investing in stocks that are only in the Dow Jones Industrial Average or the S&P 500. Now, let's think about this because this is the premise of the whole Wealthy Investor Program to begin with, right? Is that we're not guessing what $7 stock is going to be $700 5 years from now. Statistically, very few stocks actually achieve that. The reality is the stocks that pull forward the most are the ones that are in the major indexes, like the S&P and the Dow. Now, in the Dow 30, if you Google Dow 30 stocks, all those stocks will be listed. You can simply look at the chart and how the stock has performed over a 5-year period. So you're already in the winner's circle by choosing one of those Dow, okay? Most of the stocks that are in the Dow Jones Industrial Average are also in what? The S&P 500, the top 500 stocks that reside in the stock market. So instead of having to choose winners that you think are going to go higher, you could just look at their past performance. Many of the stocks in the Dow Jones Industrial Average also pay dividends. So let's think about this. While you're holding the shares, every quarter you are getting a dividend check. I like to think of that dividend check as a check that comes in every 13 weeks that rewards you for investing for college. In other words, the stocks themselves are to pay off the college tuition. The dividend is for you, mom and dad, for doing a great job. Now, what a lot of people say is, I'd like to reinvest those dividend checks to buy more shares. The answer to that is no, no, no. Because like anything that you do in life, it's all about positive reinforcement, right? So those checks are yours to maybe reinvest in your account somewhere, That is a form of residual income that is to be spent today in enjoying your lifestyle. Now, if you really want to get savvy, you take your dividend checks, put them in your savings, and now you're able to put that towards your family's annual vacation. See, there's a lot of ways to use the residual income from the stock market. You just need a methodology that works, you practice it, and then you enjoy it. You up-level your lifestyle while doing something good. So by investing in stocks that pay a dividend, you're getting a payoff now, and you're holding them for the future, their future value, and their future investment. Now, let me give you a little hint on how to choose these Dow stocks, okay? Because this is where it gets just a little bit tricky. In the Dow Jones Industrial Average, if we look at two companies and their growth now, their growth may slow in the future. So, for example, let's look at a company like ticker symbol KO, which is Coca-Cola, which is a brand that I absolutely love. I've grown up on Coca-Cola. It's a part of my family history. When you go to the movies, we reach for a Coke and we don't even think about it, and that's great. But 5 years ago, the shares were trading at $52 per share, and it pays a dividend. Perfect. I'll start saving for college with using Coca-Cola as like my anchor. Yes, but the problem is the shares were trading at $52 5 years ago. Where are they right now as of today's recording? $62.90. But Tyrone, I don't understand. These companies are in the Dow Jones Industrial Average. It pays a dividend. Why didn't the share price suddenly rise or double over the next 5 years? Because they haven't doubled in the last 5 years. So there's no interest in the stock by institutional buyers. Why? A trend in motion tends to stay in motion. If these shares have not doubled over the last 5 years, lower likelihood they will in the future. Why? Well, we're in a market right now that loves technology. And if we're quote-unquote betting on a stock's performance, we want to be in the stocks that have something to do with technology that have proved their revenue in the past 5 years. So let's take a look at a company like Disney. Disney is an entertainment company that has historically made most of its money off of its theme parks, cruise lines, real estates, hotel chains, right? And over the last 2 to 5 years, they shifted into becoming a technology company more than an entertainment company. That's why they have Disney Plus. The problem is when they made that shift, they started losing $4 billion a year. They're not that good at being a technology company. They're better at being an entertainment and, as they call it, an experience company. Therefore, their shares 5 years ago were trading at $143, and as of today's taping, they're at $100. You see, you can't venture into something that you're not good at and immediately expect to make billions of dollars because you have the name recognition. It's not transferring there, right? So when we buy that stock price, we're looking at the future of the company and the future stock price. If the shares haven't discovered, or if the company hasn't discovered how to advance the share price in the past 5 years, low likelihood it's going to suddenly discover something in the future. So although I like Coca-Cola and Disney as part of the Dow Jones Industrial Average, if I was starting an investing account today for my college, they simply would not qualify. Now, right after this break, we're going to get into some companies that are in the Dow that qualify for a price increase over the next 2 to 5 years because they are heavy in technology and they have the history to prove it. Back in a moment.
Want to increase your stock market trading profits? Then you need to start your monthly membership to WITradeschool.com right now. Don't understand how to write covered calls for monthly income? No problem. Simply review Tyrone's latest stock trades in our video library as many times as you need. WITradeschool.com is all about helping you get the financial education you need to earn money in the stock market and change your financial life. Tyrone Jackson, the wealthy investor, has helped his students earn thousands of dollars per month trading stocks online from home. These are people just like you. So what are you waiting for? Follow Tyrone Jackson's Red Hot Stock Trades and Investment Strategies today. Don't wait. Start your monthly membership at WITradeschool.com right now.
All right, let's get back to this idea of investing for college using members of the Dow Jones Industrial Average who have already proven from a revenue standpoint that they know how to grow their revenue as a technology company. Therefore, we can, take a chance on those companies in the future. Number one, Microsoft. Now, remember when Microsoft started as a publicly traded company, it was all about an operating system to run your computer. What makes them brilliant is that they've adapted over the last 25 to 30 years, and now they're in all sorts of segments of the technology business, including the cloud and gaming, among others. They're still in the operating business, but they've added these other revenue streams, which have driven the top-line revenue. 5 years ago, these shares were trading at $137, and lo and behold, where are they today? $441 a share. So would Microsoft, given their track record in technology, is there a high likelihood they're going to be around for 5 years from now? Yes. If they're not dominant in a subject, what do? They go and buy another company. They have a history of expanding in technology and software, and they're doing it well to grow the revenue. Why are they growing the revenue? They're growing the revenue to please shareholders like you and I. That creates demand for the stock, right? See, there's a pattern there. Disney crossed over into technology, not really their thing. Microsoft keeps adding on these streams. Now, Microsoft, if you look at the history of the stock, its dividend, the amount of money that they're paying out to shareholders, is constantly growing over time. So that's what you want, a stock that has a high probability of being well-positioned for the future because they stay in their lane, which is technology and software, and that process of developing new companies, buying them, increasing revenue, they happen to do that very well. Remember, a trend in motion tends to stay in motion. And then, of course, there's the ubiquity of Amazon or Amazon.com, who adds on technology segments, and they're very good at monetizing that. So would that be good to add to a college fund? Absolutely. 5 years ago, the shares were trading at $93 a share. Where are they now? Do you want to guess? How about I just tell you, $186 a share. Have these shares gone up 100%? Yes. So in life, like in the stock market, you're supposed to stick with winners. People in your life who add to your life because they're always learning and growing and adding value in their life. Therefore, as a friend, they add value to your life. Well, if we do that in real life, if we stick with winners, people who are smarter than us and have this quest to always be up-leveling themselves emotionally, spiritually, and intellectually, you're going to benefit from having that person in your life, right? So every business that I own, I try to be of benefit, of value to the people who work with me and for me, right? I want them to own stocks. I want them to up-level their life, not just work with me. I want to have an impact on their life that is for sure positive. So since you and I are friends, I want to influence you in a very positive way, which is to get wealthier, faster, sooner, and to know that that market participation is there for you. So Amazon has gone from $93 a share to $186 a share. That is powerful. Now, as it turns out, there are 40 other stocks that have done the same thing. They're not all in the Dow Jones Industrial Average, but you have to commit to learning and studying the market to be able to identify those other 40 stocks. Because if you focus on buying the shares, and every time the shares go up $10 or so, you buy more shares, we call that building a position. If I am building a position, buying more shares on the way up, that's what accelerates my wealth. Because maybe every quarter I'm checking the top line revenue on these companies, the market likes it, they drive the stock $20 higher. cool, I have a buy signal, I'm participating, and I'm watching that pattern play out over and over and over again. That is called investing. That's how I would invest for college, because as those stocks are going up in value, if I'm not selling them, I'm not triggering any capital gains taxes. My wealth is in the stock. Now, when you're about 2 or 3 years away from having to pay your first college tuition bill, you can take that account and the assets that you've built up and you can start covered call writing. Now you can take your shares and start generating monthly income. So if that bill that you're looking for 5 years from now is $50,000 a year, all you have to do is generate $5,000 a month in covered call writing. And you can meet that bill and still maintain the same lifestyle. You get it? So this is powerful when you have the right education. College won't catch you by surprise. And the account that you did nothing but invest in now converts into an income-generating account. So now you can afford college for 1, 2, or 3 kids because you know where the tuition payment is coming from. Now, there's a lot more to this, and most of it is a lot of fun once you seek that financial education, right? So not only will you have an account where you are investing for your future for your kids in their college, if you did something very similar in another account, we call that your cash account, your money would be growing, and then you'd be trading in your retirement account at the same time. So instead of fearing the future, you can welcome it with a smile because you know that you are ready. You took the Wealthy Investor program and you used it to your advantage. And that's what I want you to hold on to today. The future financially for you, no matter what your goal is bright. It's positive. It's wonderful. Why? Because you now have an income stream from the stock market that allows you to look forward to the future because you'll have more wealth. Now, I think in the episodes that come, I'm going to continue to talk about a goal like paying off your house, getting the down payment for your house, retirement, helping your parents retire better, live a better retirement, if you set a goal on top of each trading account. Final thing I want to say in today's episode, I've learned that my students do better when they assign a goal to one account and keep their main trading account for daily or weekly income, living expenses, so on and so forth. I think it's because your brain is able to then focus on one goal or assign one goal to each account. Let me also say, finally, on the saving for college or investing for college account, it doesn't require that you do anything every day. You're probably going to check that account maybe once a month. The dividend checks that are coming out of that account are arriving at your home auto-magically, by the way, so you don't have to do anything there. Your college wealth is on automatic pilot. Your retirement is on automatic pilot. If you do one thing, just one thing, use the Wealthy Investor approach. Why? Because it works. I'm Tyrone Jackson, the Wealthy Investor. That's your weekly motivation and financial education for this week. I really wish you the best with it. It really works. We're in a crazy, wonderful, dynamic market for those who have the right financial education. With that, I'll see you next week right here on the Trading Stocks Made Easy podcast.
You've been listening to the Trading Stocks Made Easy podcast. Be sure to rate and review our show on iTunes. While you're on iTunes, be sure to click the subscribe button and you'll automatically receive our next episode.